Hello everyone, welcome to today's video. In today's video, I'll talk about why I invested in a portfolio management service despite everybody advising me against it and what factors helped me take this decision. Now, portfolio management service, or PMS as it is called, is a professional service where fund managers actively manage your stock portfolio and try to achieve maximum gains, and they charge a fee for it. The minimum amount to invest in a PMS is 50 lakh rupees. As per SEBI's latest data, there are around 400 PMS funds in India that actively manage around 30 lakh crore worth of assets for almost 2 lakh investors. Now, PMSs have always appealed to me for multiple reasons that I'll discuss further. I spoke to a number of people about this, my friends, my financial advisor. I tried to do some research online, and everywhere mutual funds came out as better investment instrument than PMS. But after going through all the suggestions and doing my own careful analysis, I reached the decision that it might make sense for me, and I went ahead and invested with them. So I'll just share the points that helped me. If you are looking for similar service, they might be of some use to you. Now, the first reason is managing big liquidity event. Now, mutual funds are great, and they are especially great for systematic, disciplined investments from your monthly savings. However, there are events like big bonuses, realizing ESOPs, or sale of a big property. All these events generate a lot of a lot of liquidity. Now, investing such big amounts or such liquidity directly into mutual funds or stocks at a single go is not advisable unless you are really good at this game and you know what you are doing. 3 years back, I had a similar event when my financial advisor took the entire amount as a lump sum and invested that in a debt fund and then transferred it to equity slowly via STPs. Now, this is the ideal or the correct advisable way to invest in stock market. This minimizes the risk, but it also limits the returns that you get, as debt funds typically yields around 7%. So this time I choose the PMS route so that the entire corpus can start working for higher returns from day one. The second reason is that PMSs claim to offer higher returns with much better managed risks. So of all the 400 PMSs, I had shortlisted some PMSs that I liked. I spoke to them, and all of them quoted around 20 to 25% conservative numbers CAGR and 35 to 40% aspirational returns year on year. This is the net returns, post tax and post fees. Now, these numbers are great, but if you follow markets closely, you'll see that there are a lot of mutual funds, especially in small cap and mid cap, that have delivered similar or even better returns in the last couple of years. But then I realized that you cannot compare PMS with a specific category of mutual funds because the risk is not same. I cannot invest such a big amount in a single small cap fund or even a single category like small cap or mid cap. I will need to diversify my portfolio among large cap, index funds, ETFs, etc. And this will reduce my overall returns. PMSs, on the other hand, offer risk adjusted high returns. They are usually multi cap. They can trade in future and options. They usually buy and sell much more than mutual funds. That is why their churn ratio is higher, and that is why their taxes are also higher. But this also allows them to reduce their risk as compared to small cap or mid cap mutual funds. So in short, my target returns are something like small cap or mid cap fund, but my risks are to the tune of large cap or index funds. Now that we have a basic understanding of the risks and returns of PMSs and how they work, it is a good practice to visualize the worst case that can happen. Can the entire sum be wiped out? I don't think that is a possibility. So let us assume the fund underperforms the benchmark or index by 5%. And supposing Sensex delivers 12% for next 5 years, my portfolio would be somewhere around 7 to 8%. If we reduce the taxes as well, it would be 6%. When the fund underperforms, they do not charge any fees. So that is not counted here. So after 5 years, I'll be left with 6 or 7% returns. Now, these are unexpected, but this is the worst case that I am assuming. So in worst case, I'll be left with FD-like returns, but in the best case, I might end up with 25-30% returns, which will more or less triple the amount in next 4 to 5 years. With this calculation, I went ahead and invested in the fund. Now, fourth point is taking professional help. Now, my experience with professional financial help or advisory has been excellent since last 3 years. We as a family were investing all of our amount in FDs at 6%, and now slowly all of that amount is going to 20% year on year. So I think it makes sense for me to bet with a professional again and try to push this return to a higher 25%. If the worst that might happen is 6 to 7% after 5 years, this is worth the shot. Now, there are individuals who do great in the stock market and are able to achieve similar numbers by themselves. I am not one of them. I am not good at handling market volatility. And if there is someone who can do the job much better than me, it is just more sensible to outsource it to them. This gives me free time to focus on things that I enjoy, and also ensures that my investments are being actively managed. So these are the key reasons why I chose PMS for my investment. Of course, these are just projections and expectations as of now, and time will reveal whether these claims hold any ground or not. Since I've just invested, I don't think it is right time to name the fund that I've invested with. As results start to come in, as things progress, I'll share those details as well. So that's it for today. If you have any questions about this video or any other thing from my investment journey, please feel free to ask in the comment section. If you think that this video was helpful, please like, share and subscribe. Thanks a lot.